Section 9, Page 3, APR, Comparisons, and the questions buyers should be asking. Why is my APR higher than my interest rate? Emily and Carlos have finally reached page 3 of their loan estimate. Carlos looks relieved. One page left. Then he sees another percentage. He looks back at page 1, then back at page 3. Sarah, my interest rate says one thing, but my APR is higher. Did Jason change our rate? There it is, one of the most common consumer questions involving mortgage disclosures. The short answer is, the interest rate and APR are not the same measurement. Understanding that distinction is important. Explaining the buyer's specific APR calculation, however, belongs with the lender. Interest rate and APR are different. The interest rate generally reflects the rate used to calculate interest on the loan balance. The annual percentage rate, commonly called APR, is a broader federal disclosure designed to express the cost of credit as a yearly rate and incorporates certain finance charges in addition to interest. That's why Carlos may see an interest rate on page 1 and a different APR on page 3. The fact that the numbers differ does not automatically mean something is wrong. Sarah can explain the general concept. She should not pull out a calculator and attempt to independently verify Jason's APR calculation. If Carlos wants to know exactly why his APR is a particular percentage, Jason should explain the loan-specific calculation. Why does APR matter? Remember one of the major goals behind TILA, helping consumers make informed decisions about credit. Imagine Emily is comparing two mortgage offers. Lender 1 advertises a slightly lower interest rate, but charges higher loan costs. Lender 2 offers a slightly higher interest rate with different costs. If Emily looks only at the advertised rate, she may not be seeing the entire picture. APR provides another comparison tool. Does that mean the loan with the lowest APR is automatically the best loan for Emily? No. Different consumers have different goals. How long they expect to keep the property, the cash required up front, the structure of the loan, and other factors may matter. That's why Sarah shouldn't say, pick this one, the APR is lower. Sarah can encourage comparison. Jason and other mortgage professionals can explain the financing products. Emily makes the decision. Then Carlos finds TIP. Just when Carlos thinks he understands APR, he sees another acronym, TIP. TIP stands for Total Interest Percentage. This disclosure provides another way for the consumer to understand the potential cost of borrowing over the loan term. It expresses the total amount of interest the consumer will pay over the loan term as a percentage of the loan amount, based on the assumptions required for the disclosure. Carlos looks at a long-term mortgage and says, wait, you're telling me I could pay that much interest? Now we're getting to the real value of disclosure. Consumers often focus almost entirely on the monthly payment. TIP encourages them to look at the longer-term cost of borrowing as well. Again, Sarah doesn't need to tell Carlos whether the number makes his loan good or bad. She should encourage him to understand what he's agreeing to. Page 3 is more than APR. Page 3 also contains additional information that consumers should not simply skip. Depending on the transaction, the loan estimate provides information involving issues such as appraisal, assumption, homeowner's insurance, late payment terms, refinancing, and servicing. These may not seem exciting when Emily is focused on getting the keys to her Gilbert home, but they can matter. Take homeowner's insurance. Emily needs to understand that obtaining appropriate insurance can be part of completing the finance transaction. Or consider servicing. The company collecting Emily and Carlos's mortgage payments in the future may not necessarily remain the same entity they interacted with during origination. The disclosure helps consumers recognize these possibilities. The appraisal is not the inspection. The appraisal disclosure gives Sarah another opportunity to prevent a common buyer misunderstanding. Carlos says, we already had an inspection. Why does the lender need an appraisal? Because those are different processes serving different purposes. The home inspector evaluates property conditions within the scope of the inspection. The appraisal is part of the lender's collateral valuation process. One does not replace the other. Arizona agents should be careful not to tell buyers that an appraisal means the property is free from defects. A house can appraise and still have significant physical problems. Likewise, a home inspection doesn't establish the value the lender will use for underwriting. Who is involved in this transaction? Page 3 also contains contact information for various professionals involved in the transaction, as applicable. That may include the creditor or mortgage broker, real estate brokers, and settlement agent. This seems simple, but it reinforces something we've been teaching throughout this course. A financed real estate transaction is a team effort. Sarah handles real estate representation. Jason handles mortgage financing. The escrow and title professionals handle their respective settlement and title functions. Other professionals may include inspectors, appraisers, insurance professionals, attorneys, accountants, and additional specialists. Problems happen when people stop communicating, or when one professional starts pretending to perform everybody else's job. The which loan should I pick conversation. Emily has now received another loan estimate from a competing lender. She places both documents side by side. Sarah, just tell us which one is better. That's tempting. Sarah wants to help, but this is where helping can become overstepping. Instead of selecting the mortgage for Emily, Sarah can encourage her to compare the information systematically. Are the loan amounts the same? Are the loan types the same? Are the interest rates locked? What are the projected payments? What are the estimated closing costs? What is the estimated cash to close? Are there loan features Emily doesn't understand? Those questions help Emily make a more informed decision without Sarah becoming her mortgage advisor. Cheapest today isn't always cheapest tomorrow. This is another practical lesson. Consumers sometimes focus entirely on one number: lowest rate, lowest cash to close, lowest monthly payment, lowest lender fee. But mortgage products can have different structures and long-term consequences. A professional real estate agent should never oversimplify a major financial decision by telling a buyer to select a loan based on one number appearing attractive. Instead, encourage the buyer to understand the complete loan and ask the lender questions. That's consumer protection in practice. Broker tip: teach buyers to compare, not just shop for a rate. When a buyer tells you, "I found a lower rate online," don't immediately tell them to switch lenders. Ask whether they're comparing the same type of loan under comparable circumstances. Encourage them to review the loan estimates and discuss the differences with the mortgage professionals. And remember the real estate transaction. If Emily decides to change lenders late in the process, could that affect appraisal timing, underwriting, contractual deadlines, or closing? The financing decision belongs to Emily, but Sarah needs to understand how that decision may affect the transaction. Chapter 2 comes together. Emily and Carlos can now read their loan estimate with much more confidence. Page 1 showed them the proposed loan terms, projected payments, and estimated costs at closing. Page 2 showed them where many of those costs come from. Page 3 gave them additional loan information and tools for comparing credit. But we're not done with the loan estimate. Because real estate transactions change. Inspections uncover problems. Buyers change loan terms. Appraisals create surprises. Closing dates move. And sometimes the lender sends another loan estimate. The big question becomes, when is a revised loan estimate actually allowed? That's where Chapter 3 begins. Online discussion 1. Carlos sees that his APR is higher than his interest rate and assumes the lender changed his rate. Is that necessarily correct? Answer: no. The interest rate and APR measure different things. The interest rate is generally the rate used to calculate interest on the loan balance, while APR is a broader federal disclosure reflecting the cost of credit as a yearly rate and incorporates certain finance charges. Sarah can explain that general distinction, but Jason should explain the specific APR calculation for Carlos's mortgage. 2. Emily has 2 loan estimates and asks Sarah to choose the better mortgage for her. How should Sarah help? Sarah can encourage Emily to compare important information such as loan type, interest rate, projected payment, closing costs, cash to close, APR, and other loan features. She should encourage Emily to have each lender explain the differences and answer financing questions. Sarah should not select the mortgage product for Emily or present herself as the mortgage professional responsible for determining which loan best meets Emily's financial goals. 3. Why should an Arizona agent make sure a buyer understands that an appraisal and home inspection serve different purposes? Answer: buyers may incorrectly assume that a lender's appraisal confirms the physical condition of the property. The appraisal primarily serves a valuation and collateral purpose in the lending process, while a home inspection evaluates property conditions within the inspector's scope. Confusing the two could cause a buyer to incorrectly rely on the appraisal instead of conducting appropriate property due diligence.